Hey, what's up everybody? It's Rob Gill. And listen, I get this question all the time, and by the end of the video, you're gonna have a full education on it. The question is, and what we're gonna talk about, is how much money can you save tax-free? So a lot of folks, when we have the good fortune of sitting down with folks either over the phone, on a Zoom, or face-to-face, and we get into the whole discovery process, a question always comes up is, hey Rob, or even one of the team members, how can you save money tax-free, right? How much can you save tax-free? And it's an interesting question because in the business of financial planning, it's been our experience, there's a lot of chaos, there's a lot of confusion, and the rules are constantly changing. So to keep up with that, it requires a full-time job. Never mind being someone that's going to just invest their money and trying to keep up with all the changes, which are always tied into who's in office, what's going on at a state level. There's just a lot of different things that are constantly happening. So you may have heard at a cocktail party, at a soccer game, at a football game, hey, if you invest money into an IRA or a 401k, it's tax-free. It's actually tax deferred. And what does that mean? Unless it's a Roth IRA, unless it's a Roth 401k, if you put money in pre-tax into a 401k contribution on a monthly basis, once again, pre-tax, you don't get taxed on it that year. As a matter of fact, you reduce your taxable income by that amount, which means you save in taxes that specific year. However, when you take the money out, it's going to get taxed at ordinary income, meaning 20, 30, 10 years later, when you're 60, 65, or 70, whatever the current tax law is in that year is exactly what you're going to get taxed on in those dollars. So if it's a 10% tax, you'll get taxed at 10. If it's 20, 30, 40, you'll get taxed at 20, 30, 40%. And to that point, folks, you have no idea how many clients that come into our office that are at retirement age. They didn't have proper kind of insurance, they're uninsurable, and all their money is in a 401k and IRA, right? They saved religiously for their life, and sometimes it's worth 2 million, 3 million, or even $1 million. What they're not aware of, because in their minds, somebody told them it's tax-free, so now you got $1 million in a 401k, you're 65, that's gotta last to at least 85, right? And they didn't know when they take distributions, they were gonna get taxed at ordinary income. So if that happens this year, current taxes are anywhere between 30 and 35%. So think if you got $1 million, you're taking out 100 grand or 50 grand, whatever the number is, that money is not tax-free. That is gonna get taxed based on current tax law. So if there's 100 grand, you're getting that in your pocket 70. If they were factoring in a budget based on 100 or 8,000 a month, it's more like 6,000 a month. That $2,000 difference is the difference between 4 o'clock dinners and dinners at night with the family. There was a client that we once had that was referred by my accountant, and phenomenal woman, husband passed away, left a lot of money that was inside an IRA. And if you know anything about IRAs or 401ks, there's a required minimum distribution after age 70. By the time we started working with this woman, she was north of 80. And it was basically each year from 70 on, your RMD increases. So let's say you have a $2 million, let's say you have $1 million. You might only have to take out 10,000 when you're 70. But by the time you're 80, 82, 83, that 10,000 becomes more like 50 or 60,000. The challenge here was the woman was so afraid of the stock market, she was sitting in cash. This is before we met her. And now all of a sudden she's sitting in cash. The market happened to go up 10, 20%. Not that she would have been invested in that kind of investment, but the point was she still had to write a check out of the IRA because it wasn't invested except it was in cash, so it wasn't even earning 1%. And she had to write a $70,000 check to herself for a distribution, right? Which meant that that money was going to get taxed. And she didn't even need it because she had a pension as well. So she wanted to keep the money in there and not take it out. The challenge there is if you're not doing proper planning and you get to that point, now you run the risk of outliving your money. Like, this is a very healthy woman, believe it or not, in her 80s, and now the government was coming hard on those tax dollars based on the distribution model of the IRA. So the question becomes is, how can I save money tax-free? The first education I just gave is when you're dealing with a 401k or an IRA, It's not a tax savings, it's a tax postponement that results in substantial lost opportunity cost, doesn't give you any disability benefits, and when you take it out, it's subjected to ordinary income tax. We just covered that. The next thing is, and you have to think of like buying your straw hats in the winter when they're on discount, right? You don't want to put money into something that's going to get taxed the way we just talked about. Now, there's a certain blend, but you also want to put money into after-tax investment opportunities, right? So if you think of a Roth IRA, that does go in with after-tax dollars. That money does come back to you tax-free, right? So if the question is, how can I save money tax-free? That's one of the ways of doing it, right? The challenge there is if you make too much money on your annual basis, you cannot qualify for a Roth IRA. They won't allow you to put money into it to get that benefit because you're making too much money. It's only meant if you don't make a lot of money. Another alternative is to invest in cash value whole life insurance with after-tax dollars. It has the same characteristics as a Roth IRA, except it doesn't discriminate based on your income, on how much you can contribute. So if you fund it in conjunction with all of your other planning strategies, and the right hand is talking to the left hand from a perspective on your money, what begins to happen is the money grows tax-free and comes back tax-free up to basis, and to maintain that tax-free status, you would borrow from the policy. We always talk about how it's a Swiss Army knife, and in the space of that Swiss Army knife, it gives you protection from taxes, market volatility, market risk, and the ability to manage your money and look at your money differently on the distribution side so you can maximize your wealth while you're alive and then have a wealth replacement vis-a-vis the death benefit when you shuffle off this mortal coil. So folks, listen, not only do I want you to feel comfortable going into retirement, but even for the folks that are out there that are still in the wealth accumulation phase and you want a real solid education on all of the products that are out there, their advantages and their disadvantages and how it works whether you're 45, 55, 65, 35, or 25. So we've already thought of this for you and we've created a financial freedom map. Click the link below and check out the education and clarification.